and welcome everyone to Nixon Peabody's What's New virtual series. I'm Richa Naujoks, an attorney in our Long Island office. Today I'll be talking about what's new in emerging company capital raising. Feel free to ask questions using the Q&A box below. I will do my best to scan the questions and answer any of the ones that are of general interest at the end of the session, but we've got a short window, so if I don't get to your question, I will follow up with an email response afterwards. With that, we will jump right into the talk. So what a year it's been, right? As with emerging company fundraising, as with everything else, it's been a year of things that we didn't think would be different being different, and things that we absolutely thought were writ in stone, sort of basically all being up for grabs again. So I'm going to focus on three things: the holy trinity of startup fundraising, which is valuations, terms of the investment, and exit, and sort of give you an overview of what's changed in these three areas. In terms of valuation, at the beginning of the pandemic already, we were seeing VCs sitting on a mountain of dry powder, and that trend has increased because whereas in some sectors there's been a lot of deployment, other sectors has been sort of shy of deployment. So there's a lot of ready investment waiting for the markets to pick up in certain of the sectors. Valuations, which I personally think were sort of artificially bloated by the end of 2019, in some sectors actually surprisingly stayed bloated. So especially when you're thinking about kind of early stage fundraising, I'm talking about Series C, D, E, and beyond. There we continued to see really massive valuations. In the earlier stage of the early stage fundraising is where I saw a little bit of right sizing, if you will, of valuations. Some sectors, there's also been sectoral differences. I feel like the pandemic has really just broadened fault lines that already existed. So brick and mortar retail was struggling before, continued struggling. All of the sort of planned investments, majority of the planned investments pre-pandemic sort of ground to a halt, and not too many were being done during 2020 and 2021. Other sectors, retail tech, food tech, healthcare has just been extremely active. High valuations, good terms for the founders, for the early stage backers. So that in a nutshell is what's been going on in terms of valuation. Bloated valuation in some sectors, and at later stages, a little bit of right sizing at the really early stages, with pockets of very active in terms of the terms of offering. So interestingly, in the start of the pandemic, I saw a lot of safes and notes. I think that was sort of or what I'd like to call emergency fundraising. Didn't know how long we were going to be, separated from the markets, what was going to go on. So there was especially with sort of capital heavy industries, life sciences, where there's going to be a need for capital for the next few years before there's any revenues. in areas like that, I saw a big slew of sort of emergent from existing investors, and people that were already kind of within the network, from founders, etc. as I want to say the summer wore on in 2020, that again there was sort of a right sizing, if you will. I think people realized that we were there for the starting to realize, I should say, that we're in this for the long haul, and that's where I saw terms go right back to what I call normal. So on a safe or a note, we're looking at a 20% discount. Really early stages, we're looking at a 5 million-ish cap on valuation for the next round. Preferred preferred stock terms are continue to be NVCA, fairly standard. Nothing terribly out of the ordinary that I'm seeing. So that's it on terms. The one that I really wanted to focus on was exits, because that's the area where I feel like we've had the biggest sort of overhaul. Um, I would say maybe end of 2019, realistically for an early stage company, the exit options you were looking at for the founders and the early investors was either an IPO or being bought out by private equity. That's where I feel the landscape has really changed in the last, call it 12 months. Biggest newsworthy item, of course, is the emergence of SPACs, which is not a new animal. It's at least in my career, I've seen at least two resurgences of the concept. It was called blank check companies a couple of years ago when it came out. A few years before that, we talked about reverse merger listings. So it's sort of had different flavors, but the idea has been the same. In a nutshell, a SPAC is raising capital with the aim, going public with the aim of having available capital to make an acquisition of an early stage company. And the money is essentially kept in trust. So from the investor's perspective, if the SPAC sponsors find a good target, they deploy the funds, and if not, funds get returned theoretically. So what this means, and this has been, as everyone on the call knows, this has been record levels of activity in terms of SPACs. I'm looking at some numbers just before this. I think they said PitchBook says 80 billion of $80 billion were raised SPACs in 2020, and in essentially the first 10 weeks of 2021, we're back up to another 79-ish billion. So there is a lot of dollars sitting in public entities waiting to give early stage companies an exit. And the reason I'm talking about that's not really emerging company financing, but the reason I'm talking about that is because when you're thinking about anything in terms of valuations, in terms of the terms of the investment, as an investor going in, or as a founder talking to investors, sort of that's the eye on the ball is, where is the exit coming from, and that's where SPACs is sort of ready exit option. Like everything else, in fact, interestingly, so the last two times in my career that I saw, a rise of the blank check company, if you will, each time the sort of, the downward trend was driven by disclosure and sort of enforcement action. So it looks like a very interesting vehicle to use, and then the SEC starts to get involved and says, if it's all that easy, what are you not telling investors that you should be telling investors? So we that's where I think the trend is maybe not going to go on a downward swing, but at least plateau, because once the SEC, which has actually gotten involved, there's been one enforcement action, there's been a couple of news releases where the SEC is talking about what they expect to see in terms of SPAC disclosure. As the sort of disclosure burden goes up, the relative cost of SPACing goes up as well, and the benefit, the delta between the arbitrage sort of arrows in terms of the benefit of. So that is, I think, one of the things I'm seeing. The other one, which I've not seen a lot of in the last, I want to say 12 months, but I was starting to see a trend in 2019, is secondary transactions as a potential exit source. Again, from the perspective of founders and investors, it's just looking at, when you're drafting terms, you're not looking at what will the cap table look like when it gets sold. You're looking at what will the cap table look at once I have liquidity, which is a very different sort of lens to be looking at fundraising. So the other thing in that sort of bucket that I want to talk about is secondary transactions. Interestingly, this was not a trend that I was aware of, but towards the end of 2019, I had two or three separate clients come to me with an offer to buy their private company stock options, vested stock options of employees. So apparently that's a trend that was just starting to pick up. Again, I haven't seen too much of that in the last year, but that makes sense, because if I'm an employee at this point, I'm probably going to hold on to my options rather than seek liquidity. But the idea is a platform that buys larger public company vested options, helps you exercise them, and then trades the stock on a secondary platform, um, so to speak. That's been on the secondary side. Also, there have been some fairly large, noteworthy secondary transactions. So SoftBank did a big secondary transaction. So it's sort of investors buying the position, or later stage investors buying out the position of early stage investors as a potential form of exit, which I don't think, at least I wasn't seeing a ton of. Um, Let me see. Anything else I wanted to talk about? No, that's it. I think I have. Oh, that's great. I've left 5 minutes for questions, so I will free to your questions in the chat box. If there's other topics that you'd like me to talk about, feel free to put that in. Seeing none, Alexis, do we wanna wait, or?
Risha, this is Susan. There is one question. The question is, do you see active investments in pre-revenue companies or companies in a med device products? I'm sorry, do you see active investments in pre-revenues companies? Our company is in med device products. Any route more popular?
Oh, sorry. For some reason, my chat box was not showing up. Um, I do. Med device is an interesting animal. So pre-revenue, I feel, um, one thing that hasn't changed is for pre-revenue, I would always start off by looking at angel investors and potential incubators, etc. The med device is an interesting space where feel one route that's a little bit less looked at is, well, two things actually. So there's sort of the standard early stage investing route, which I would call angel investors, very early stage VCs, and maybe angel groups would be a potential target. The other one is sort of pre-sales on commercial revenue. So if there's a distribution contract, to the extent that can be pre-funded, or if there's a potential distributor or distributors or manufacturers, they can be I've seen promissory notes, or convertible notes, I should say, from potential commercial parties in order to pre-fund the development, the manufacture. That again, that happens a little more where you've got a raw man med device or an approved device, and you need to get to FDA approval, or just where it's bridge funding to get to the next stage. But sort of you don't think about it as funding, but pre-funding from a commercial source to me is a good option for med devices. The other thing which 2 years ago I would not even have suggested, but I'm seeing inventory financing for sort of smaller pre-revenue companies, as long as there's a good a good product base, as long as there's sufficient inventory in order to form the collateral of that financing. That's a great option. If you can get the inventory financing, to me that's a great option because it's non-dilutive. You probably have a higher interest rate than you would at a later stage, or post revenue, but it's still you're paying dollars for the dollars rather than equity for the dollars, which to me is a big. I don't know if that answered what you had in mind.
And at this time, there's no more questions.